No one really wants to look at the backdrop, the structural damage that we've done to the United States economy. And I think that's the key piece of the puzzle. The balance sheet in America is fraught with risk. The corporate balance sheet is actually much improved. We've actually owned companies over the last year. We've been finding good value, not now, but starting a year ago when Lehman came unglued. But I would say that the earnings power of most companies going forward will be very challenged. We're already seeing it. I mean, they're reporting third quarter numbers. You have top-line revenue that's come down, companies cutting expenses, trying to make the profit estimates that Wall Street's put out. But I think the biggest problem is the bull market that we had starting in 1982, which clearly ended in 2000. You have a lot of people in this industry that have built their business models around a bull market, about buying dips, about getting long, and I think this is a very different environment. I think this environment is going to include much more intervention going forward, much more in the way of subsidies for certain industries going forward, and we're actually spending a lot of the time just kind of understanding the interventional analysis piece of the equation, because it seems like every time we turn around, the government is involved, and that is strengthening the bull case, and we look at it as saying, no, you want to be as far away as possible from industries that are involving more and more government intervention.
We'll close with just two other questions here, Bill. Valuations. Analysts calling for $75 earnings per share on the S&P. What are your thoughts as you look at the valuation situation?
Yeah, I think, if you go back again to the Lehman situation, I mean, we were buying a lot of businesses below tangible book, during the meltdown last October. We've had a tremendous rally in various sectors since then. I would say some sectors are clearly way overvalued. Some are fairly valued. Very few are undervalued. We have not been doing much in the way of buying. Actually, we've been taking profits on a number of long positions. I think that the $75 number being kicked around, and again, this is the same group of people that were calling for $100 2 years ago. I think it's a fantasy. We no longer have gain on sale accounting. That was a large part of the earnings that were being produced during the credit bubble. Let's face it, we had the greatest credit bubble in history, and the government's trying to recreate that shadow banking system, that credit bubble. I think they are going to fail miserably. But look, financials can put up a lot of different numbers, but if you're not marking assets to market, and you have a lot of these loans being suspended in animation, they're not classifying those loans as non-performing when they should be. You really have to discount the earnings coming out of the financials. And I think people are doing that. I don't really think people believe the numbers. Right now, it feels good to be bullish with the rally that we've had in the marketplace. But I think the reality is that the sustainability of the recovery is a low probability event, no question.
So how are you guys positioning yourselves over there at Bearing Asset Management, Bill, going forward to make your clients money in this type of an atmosphere?
Well, it's a good question. If you look back at 3-4 years ago when the credit bubble was near the peak, we had positioned ourselves. We were net short actually a little over 200%. Today, we're running a very different portfolio. We've been increasing our short exposure on the rally of late. We've been long a basket of tangible assets that have performed much better than the overall market. And, let's say, for example, that the market increases another 3 to 5%, we would increase our short exposure even more. I think there's a lot of people right now pressing the long side because they underperformed last year and or the year before, so they're either long or levered long. I don't know many people who are willing to short the market today. I think it's fairly evident that the shorts over the last several months have been hit hard. Fortunately for us, we've had good hedges in place, and we're still up for the year. But I think the next move here is down. I don't know how far down we'll go, and as Mark Faber has mentioned many times, what is the next wave of intervention from the government? But I think it's clear that the governments, the powers that be, what they've thrown at this economy in terms of new money, backstops, etc., again, not a whole lot to show for it. So I would say that the government chamber is running out of bullets, if you will.
Bill Laggner, Bearing Asset Management, thank you so much for joining us.
Thank you very much for your time, Eric.
Thank you for joining us at KingWorldNews.com. Remember to tune in next week where we will have John Hathaway of the Tocqueville Funds, famed technical analyst Luis Yamada, as well as Michael Lewitt of Hart Capital. Also, remember to go to our Gold Plus page for exclusive weekly interviews with Ted Butler and Gatta, and where next week we will have special guests John Duty and John Rubino.